Trump's 50% tariffs spark auto losses, rising prices. And energy risks, tariff war escalates, Trump versus Canada, auto jobs, see USMA. And oil at stake, America's auto industry under siege. How Trump's tariffs could break Michigan. Breaking down the impact of Trump's steel and aluminum tariffs. The Trump administration has taken another major step in trade policy. On Monday, tariffs on steel and aluminum imports were expanded, doubling rates to 50% and extending to more than 400 products that contain these metals. For consumers, the answer is simple: higher prices. From canned food to home appliances, the cost of items used daily across America is rising when the White House announced the expansion. In mid-August, importers were given no grace period. Goods already en route to U.S. ports became more expensive. Overnight, the list of affected products is long, and familiar car parts, electronics, soda cans, and household wiring core items of modern life. For businesses, the bigger issue is unpredictability. No one knows which category of goods might be targeted next. This sudden expansion shows how quickly trade policy under President Trump can reshape the ground beneath households and industries alike. The numbers back it up. According to the Producer Price Index, domestic steel products rose nearly 9% compared to last year. While aluminum jumped over 13%, these increases feed directly into the prices of cars, refrigerators, and even basic groceries. Factories across the Midwest, long considered the backbone of American manufacturing, are already feeling the strain. Manufacturers point out that certain types of aluminum are simply not produced in the United States. That means tariffs add costs without creating a local substitute. Smaller firms are hit hardest. Unlike global corporations, they cannot easily absorb the added expense, leading to layoffs and financial stress in towns that have depended on stable factory jobs. For decades, north of the border, Canada has taken a different approach. Ottawa swiftly introduced countermeasures, including 25% tariffs on nearly 30 billion Canadian dollars worth of U.S. goods. Canada also implemented quotas on foreign steel and restricted government procurement to trusted domestic suppliers. Financial assistance was prepared for major aluminum producers like Rio Tinto, ensuring jobs and operations continue even under U.S. pressure. The contrast is clear. In the U.S., tariffs were promoted as a path to bring back jobs and strengthen industry. But so far, higher input costs are driving inflation and forcing layoffs in manufacturing. For American households, everyday purchases from canned food to cars are becoming more expensive. Meanwhile, Canada has used the moment to reinforce its own industry, protect workers, and stabilize supply chains. This has become a test of tariff politics pushed too far. Short-term protection can end up hurting the very workers it aims to defend. President Trump's policy highlights the risk. Protection at home may backfire, raising costs for consumers while unsettling global trade. Even state leaders are voicing concern. In Michigan, the governor directly warned President Trump about the damage these tariffs could cause to the auto sector, the lifeblood of America's car capital. Tariffs were meant to protect, but are they putting America's industries at greater risk? Michigan's auto industry under pressure. The tariff effect in Michigan, the heart of America's auto industry, the pressure is building. Over the summer, President Donald Trump's latest tariff measures landed with force. The numbers speak for themselves. General Motors reported its second quarter profits fell by $1 billion, citing new import taxes as a major factor. Stellantis announced a staggering $2.7 billion loss in the first half of 2025. And while Ford's latest results are not yet public, analysts already predict the same trend. Tariffs promised growth, but delivered strain. The tariffs were pitched as a way to bring manufacturing back to America. Yet here in Detroit and across Michigan, the early impact is unmistakable. Higher costs, squeezed profit margins, and a growing unease that the policies may be hurting U.S. companies more than foreign competitors. 50% tariffs on metals, a heavy burden since June 2025. Imported steel, an aluminum essential for vehicle frames, chassis, and countless components have carried a 50% tariff. Canada, America's largest aluminum supplier, now faces a 35% duty on non-USMCA shipments. Mexico was given a short 90-day delay, but the threat of 50% tariffs on metals and auto parts still looms large. Beyond North America, India's rate was raised to 50%, impacting key automotive materials, even interior trim leather, textiles, and fabrics imported from Asia's caught in the tariff net. The reality is simple. In today's global supply chains, a car stamped made in America still depends on dozens of foreign-sourced parts. Now, many of those parts are taxed heavily before they even reach a Michigan factory floor. Costs are climbing. Consumers will pay so far. The big three automakers have absorbed much of the impact, but the pressure is mounting. According to the Center for Automotive Research, tariffs on autos and parts alone could add $18 billion in costs to the industry this year. That figure doesn't even include the knock-on effects of 50% tariffs on metals or the layered duties from multiple partners. The Alliance for Automotive Innovation has warned that eventually, these costs will move downstream straight to the consumer. For buyers, that means higher sticker prices. Some entry-level models may even vanish from the market, cutting consumer choice and slowing the rollout of new technologies. Electric vehicles face extra challenges. Electric vehicle makers face an additional obstacle. The U.S. still lacks a large-scale domestic battery supply chain, forcing reliance on imported components. With tariffs now steep, the cost of building EVs rises even further just as the nation is trying to accelerate the transition to clean energy. In Detroit, fewer cars on the line doesn't just mean less inventory. It means fewer jobs in communities that have spent decades rebuilding from past downturns. Analysts warn that if these policies continue, the next 3 years could bring sustained declines in sales and employment. Trump versus Carney to competing trade visions. President Trump views tariffs as leverage, a tool to pressure trading partners into making concessions and investing more in the U.S. But Canada's Prime Minister Mark Carney has chosen a different strategy. He has kept most Canadian expo artistes tariff-free under USMCA while exploring new trade routes abroad. His argument is clear. Steep U.S. tariffs may raise costs for American consumers and manufacturers more than for Canada itself. It's a clash of two philosophies: Trump's aggressive push for fast results versus Carney's steady, alliance-driven approach. The outcome will decide whether tariffs bring stronger U.S. production or deepen the strain now. Hitting Michigan's factories, warnings from Ontario, a volatile situation. The uncertainty doesn't stop there. Ontario Premier Doug Ford issued a blunt warning in a recent press conference. He cautioned that President Trump could end the KUSMA trade agreement not in 2026 as expected, but as early as November 2025. All it would take is one signature, Ford said. This, he warned, is not a normal trade dispute. It's something far more volatile. For America's auto sector, the stakes could not be higher. The question now: will tariffs rebuild strength or break the backbone of Michigan's economy? CUSMA at risk? Trade uncertainty in North America for Ontario Premier Doug Ford, a provincial leader with strong ties to both business and conservative circles. The warning carried real weight. His concern was not simply about tariffs, it was about CUSMA, the very legal backbone of North American trade. The agreement itself may be at risk. Ford's alarm is widely shared. As one strategist explained, almost every country trying to negotiate with this administration finds it challenging. You think you're close to a deal, and then it falls apart when it reaches the president's desk. Conservative strategist Corey Taney put it bluntly, the worst may still be ahead. Unconventional tactics, unpredictable outcomes. President Trump's trade approach does not follow conventional norms. He has moved away from established frameworks, rejected predictability, and applied heavy pressure without always presenting a clear path to resolution. The 35% tariffs imposed on Canada under the IEPA are just one example. The negotiation process now seems to move according to Trump's own timeline and his own mood. That unpredictability has eroded trust. Even though CUSMA itself was originally signed during his presidency, Canada and Mexico building a new foundation. Canada and Mexico share about $50 billion in two-way trade. With so much at stake, neither country can afford uncertainty. This week, Canadian foreign affairs and finance ministers traveled to Mexico for high-level talks. These meetings were not ceremonial, they were strategic. Business leaders and trade officials sat down to coordinate supply chain goals, expand infrastructure, and build a joint response to what one expert described as a toxic atmosphere. Legal battles over tariffs. The timing is complicated. On July 31st, the U.S. Court of Appeals reviewed the legality of Trump's emergency tariffs. Lower courts had allowed them to proceed, citing ongoing talks with China, but the final ruling could still shift the ground beneath North American trade. For Canada, this raises a difficult choice: accept a risky agreement now, or wait for legal clarity that might never arrive. Canada turns inward, strengthening itself inside Canada. A new message is gaining ground. Instead of simply reacting to U.S. moves, the country is revisiting large-scale projects long delayed. Infrastructure initiatives that should have been started 20 years ago are being put back on the table. Alberta wants to protect oil. Ontario is focused on autos and steel. Quebec prioritizes aluminum, but Ford emphasized that 98% of priorities overlap. The divisions are shrinking. The urgency is growing. This is no longer just about defending individual sectors. It is about defending economic sovereignty. A blunt warning: CUSMA could end overnight. Ford's warning was blunt. Tariffs alone may not be the end game. Trump could attempt to dismantle CUSMA itself. Decades of trade predictability could vanish with a single signature. Canada and Mexico are no longer waiting. They are preparing, because when trade becomes a power struggle, stability itself becomes strategy. Energy security, a hidden pressure point. Canada is the fourth largest oil and gas producer in the world and exports 97% of that energy to the United States. In fact, 60% of the oil and gas America consumes comes from. President Trump has said he wants to protect U.S. energy independence, but critics warn that his trade measures could unintentionally weaken the very foundation of that security. Canada's oil, the backbone of America's energy supply. Canada supplies between 50% and 70% of all U.S. oil imports, averaging about 4 million barrels per day. According to the U.S. Energy Information Administration. This isn't just about volume. Canadian crude is uniquely compatible with U.S. refineries, especially those in the Midwest. Many of those facilities were built to process heavier oil grades, the very type Canada produces in abundance. And unlike oil from OPEC nations, Russia, or Iran, Canadian energy comes from a stable, democratic neighbor. It is not subject to sanctions, political manipulation, or geopolitical conflict. Washington understands this reality. That's why, even as President Trump imposed sweeping tariffs on Canadian steel, aluminum, and manufactured goods, oil was left largely exempt for now. Why oil matters in the heartland refineries in Minnesota, Illinois, and other swing states depend heavily on Canadian oil. Analysts warned that if tariffs were extended to energy, refiners would have little choice but to pass the cost on to consumers, potentially raising prices by 50 to 75 cents per barrel. Exempt for now, but not safe exemption is not security. Trump's trade policy is built on threats and uncertainty. As part of his hardline America First stance, he has warned of 35% tariffs on all Canadian exports, including oil. If Canada refuses to accept a new bilateral agreement, currently, Canadian oil faces only a 10% tariff. But the constant threat of escalation has already shaken investor confidence. When companies cannot predict future tax levels or border access, they stop planning for long-term growth. According to the ARC Energy Research Institute, total investment in Canadian oil and gas for 2025 is down 25% compared to the 3-year average. That translates into fewer drilling projects, fewer pipeline expansions, and no increase in supply to meet U.S. demand. A strained infrastructure, the slowdown is already visible. Canada's largest export line, the Trans Mountain Pipeline, is running near capacity. Other major projects, like Energy East, were canceled years ago. With political risk and cost inflation rising, new projects remain stalled. To compensate, Canada is attempting short-term upgrades, but those are stopgaps, not solutions. This bottleneck makes the U.S. energy system more fragile. A single disruption from maintenance, extreme weather, or even sabotage could tighten supply, spike fuel prices, and leave refineries struggling. Instead of reinforcing a secure energy partnership, U.S. trade policy is adding instability, the very opposite of energy independence. Canada pushes back, facing pressure. Canada is not folding. Prime Minister Mark Carney has taken a firm stance. Canada will not sign a bad deal just to avoid tariffs. Carney understands the leverage Trump can threaten, but he cannot afford to lose Canadian oil. Ottawa is buying time, strengthening domestic resilience, and working to attract long-term investment back into its energy sector. At the same time, Canada is diversifying its trade partners, expanding ties with Europe and Asia to reduce over-reliance on the U.S. market. Rather than panic, Canada is playing a longer, steadier game. Tariffs backfire. A strategic irony, Trump's belief is that tariffs force countries to fold. But with Canada, the strategy is backfiring. Instead of pressuring Ottawa into a quick agreement, the threats have triggered a pullback in energy investment, weakening a cornerstone of America's fuel supply. The irony is clear. In trying to make America stronger, Washington may be making its own energy future more vulnerable. The real question: how can you win a trade war if your own energy supply becomes the first casualty?